On June 15th, the Federal Reserve did one of the biggest interest rates hikes since 1994 of 0.75%, or as they commonly say it, at around 75 basis points, bringing the overall effective federal funds rate currently at 1.58%. And after this occurred, the markets actually did a little bit of a rally, only to lose everything the following day. Now the question is, how does this actually affect us day to day, as well as if we would like to invest in the stock market currently based on the fact that interest rates have gone up? Howdy everybody, and welcome back to another special video. Today, I would like to go over a couple points as to what we should be doing, or at least what I'm going to be doing based on this interest rate hike that the Fed actually increased, and whether or not the Fed will actually be able to bring down inflation in the future. Now, this video idea was actually brought to you by Vivek, where he actually commented on my Kroger video saying, should we invest now or increase emergency funds? Will the Fed be able to bring down inflation by next year with this much variables? Any videos on this and FOMC meeting. So I'm going to give you guys what I'm going to do in this scenario, and again, this is not financial advice. This is again what I'm doing in my opinion on everything that's about to happen in the future when it comes to this Fed rate hike. So with that said, let's get started with this video. Here we have my investment portfolio on M1 Finance, a dividend passive income. Now, I have shown this before in other videos. However, just in case you're new, maybe you're seeing this video for the first time, I do have an investment account, guys, and here it is, worth $95,034.88. For all of those of you who may actually have seen my previous videos, well, you could probably guess that it has actually gone down a significant amount. As you can see right here on the value over time on the monthly, my highest that I've actually been was around almost $106,000. And well, we're currently down to 95, so currently down almost $10,000. And if we actually even take a look at the quarter, I am even down more from peak, where in this case, the highest was of April 20th, 2022 at almost $108,000. So you can just see that by the market going down because of these news of Fed interest rate hikes, and of course the whole inflation concept as a whole, my portfolio has taken a beating. Now, what am I currently doing with this information of the Feds being hawkish when it comes to raising interest rates and bringing down inflation? I am actually really glad that they're doing this, solely because of the fact that inflation is a killer when it comes to pretty much everything, right? It decreases your buying power and is pretty much an invisible tax to the lower and middle classes. And when CPI actually came out for the month of May on the 10th of June, a lot of people actually guessed between 8.5 to 9%, which ended up being correct. It was at around 8.6. Honestly, I figured that this was going to be a lot higher. I thought it was going to be 1% higher from the previous month of April, where it was 8.3. I thought it was going to go all the way up to 9.3, 9% minimum. However, it came out to be a little bit less than that, as I said, at 8.6. And even though I was wrong and it didn't go to minimum 9%, the stock market still fell a pretty huge amount on the 10th, just when these news came out. So the fact that the Fed increased interest rates hike by 75 basis points, which they said that they would never do, they said that they wanted to keep it at 50 basis points pretty much throughout the whole entire rate increase cycle, pretty much just tells me that they highly underestimated the inflation rate increase. But what does this actually mean in regards to your day-to-day life? Well, for starters, an increase in interest rates hike actually increases, guys, the treasury bond yields. Currently, the 5-year is actually inverted with the 10 and 30-year, and the 2-year is getting very, very close to inverting with that of the 10-year. This basically means that just taking on debt is going to be significantly way more expensive than what it was before. The prime example that we actually see here is the fact that mortgage rates, guys, have gone up to 5.741% on the 30-year fixed, which is just absolutely insane. On the 15-year, it is 4.846, and on the 5-year ARM, it is 4.273. So this is up almost a little bit more than, I believe, 100% since 2020 and even 2021, where it was at around like 2.75, 2.5, maybe 3 at some point. So it was around 100%. It has increased within the past year or so, which is just mind-boggling. So essentially, the fact that the Fed has increased rates by 0.75 and they don't seem like they're stopping this, you will essentially be paying a lot more in your monthly mortgage on a house if you were to buy a house right now. Even though you are paying more on a monthly mortgage when it comes to this actually might have a pretty bright side, in that the fact that when mortgage rates go up, people tend to buy less houses, meaning that essentially more houses will be on the market, bringing down the price hopefully in the future. We have still yet to see that. However, housing usually takes around 3 to 6 months to catch up with any crash or at least dip that they might have. So this is essentially what the Fed's interest rate hikes is doing, at least for you personally. Now, when it comes to companies in the stock market, well, companies take on debt, right? We have analyzed here on the channel, net debt and just total assets and liabilities in general, right? So whenever a company takes on debt, now the fact that it is more expensive to borrow that money, companies will not be incentivized to borrow as much as they did before. And the types of companies that are most affected by this is none other than the tech sector. In fact, the NASDAQ is the one that has fallen the most on the 1 year at 23.04%, and on the year to date, guys, it is down 31.8%. So clearly, because of these interest rate hikes, the fact that it's harder to borrow more and more money, it is definitely taking a tumble on the NASDAQ index, which is mainly comprised of tech companies. Now, this could be either a good or bad thing depending on what companies you like. If you are invested, or if you like to invest in a company like Apple, well, you really don't have any problems here, because if we actually look at Apple's free cash flow here in the cash flow statement, we can see that they are almost at $106 billion in free cash flow just this year. However, if you are invested in a company like, let's say, Palantir, then you might be in a little bit more of a predicament, because, well, while they are up when it comes to their cash flow, they have not been completely positive in the past 5 years when it comes to their cash flow, right? They just became profitable, at least in the cash flow perspective, just 2 years ago. So this might be a little bit more risky of a play, and seeing the fact that they can't borrow anymore, at least they can't borrow to the same extent that they used to before, this might be a little bit of an issue. So what am I personally doing when it comes to all of this and when it comes to investing? The fact of the matter is that when it comes to me, what I'm personally doing is I'm saving up a little bit of cash because I am actually going to save up for a house. That's kind of my MO right now. I would like to buy a home. And you're probably saying housing prices are extremely up and mortgage rates are up. Right, the fact that mortgage rates are up pretty much is telling me that we might have a small dip in the housing market. Does this mean I'll pay a higher mortgage rate? Sure, absolutely. But if the price overall comes down and I have a higher interest rate, then essentially I would be paying the same if the price would be higher with a lower interest rate. Same principles apply. It's essentially almost a one-to-one comparison. You'll be paying roughly the same. We have still yet to see the housing market go down, but I am hopeful that by the end of the year, around maybe October or November, maybe December, the housing market would come down a little bit. Hopefully, we shall see. Now, when it comes to stocks, I'm currently not investing as heavily as I would like to be, mainly because, again, I would like to save up for a house. However, in the case of all of you guys that may already have a house or just would like to invest regardless of whether or not you want to buy a house or not, my suggestion is this: when it comes to this whole inflation situation that we are currently at and the fears of a recession, me personally, guys, I would invest in, of course, food and water. Make sure that you have essentials already, because if things really do hit the fan like we have been seeing and we have seen a lot of people talking about recently, where we have all these food shortages, there is a fear that at around harvest season, so end of spring, beginning of fall, we may not have the fertilizer shortage that we're currently facing right now. It's going to impact food prices a significant amount. So in my personal opinion, guys, I highly suggest all of you guys to go out and buy a bulk of food, because you do not want to go hungry. Make sure you have water. If you want to use like a filter or something like that for water, make sure you do that. If the fertilizer shortage hits in late spring, early fall, you do not want to be fighting for the last can of beans in the parking lot of a Walmart, right? You do not want to do that. That's the first thing. The second thing is that I like to personally have a nice cushion of around a year's worth of my expenses, just in case something bad were to happen like this, right? You want to be able to make sure that you cover a roof over your head, and then in addition to that, of food. So I like to personally have 6 months to a year of safety net when it comes to cash on hand. And lastly, after all of that is set in stone, then I would personally put all of that excess money into the stock market, into companies that have fallen a significant amount. And if you guys use my discounted free cash flow calculator and you think that they are undervalued based off of your own assumptions, then by all means you should 100% buy them based off of the assumptions that you guys make, because of the fact that they are significantly cheaper. And wealth is actually created in bear markets, not bull markets. You want to buy right now because of the fact that stocks are cheaper and your money actually buys you more than what it was just a couple months ago. In fact, even though I just said I'm not necessarily investing in this market right now, I actually did do a buy just on June 16th of AVGO, or around $500 or so, mainly because of the fact that Broadcom fell under $500 for the first time I have yet to see since 2020. Now, this company rallied, guys, to $677.76 at the peak. And if we actually take a look at what they actually were, guys, at the bottom of the pandemic, they were down to $167.87. Going from 167, essentially 168, to $677 is just mind-boggling. And on top of that, guys, they have a massive dividend of $16.40 per share, with a 5-year growth rate on this dividend of 38.24% and 11 consecutive years paying out this dividend as well. So me seeing that they fell down under $500, and I do believe that when it did the stock analysis, I had them pegged at around like $550 as a good price tag. I pretty much just said, you know what, I have to take the opportunity and I have to buy this company because I don't think I'll be able to get another chance at this. So I decided to at least buy one share at $500 or so. So that is essentially my recommendation when it comes to all of this, because I personally think that this will get a lot worse, guys. And the Fed raising interest rates by 0.75 percentage points pretty much is telling me that they were 100% wrong when they were screaming inflation is transitory just a couple months ago. In fact, I even said this cannot be transitory. It's impossible. They're lying. They're lying. They're lying. And now they quickly changed their tune, and they have not taken accountability as to what they were saying just a couple months ago. So the fact that they're saying that the US economy is strong, the fact that they're saying that we won't go into a recession, pretty much is telling me that we will go into a recession and the US economy is not strong at all. And the fact that they are now taking inflation seriously, only raising it by 75 basis points, it really is telling me that they don't really care about this. If they really wanted to quell down inflation, they would have to raise it above the inflation marker at 8.6%. Which probably isn't going to happen. So will inflation come down, guys? I personally don't think so. They would have to severely increase it beyond the 8.6%, just like we had back in the 70s, where Volcker had to increase it to almost 20% to bring it down just a couple of percentage points. So I personally think that inflation will not come down. Things will continue to get worse. So I highly suggest you prepare yourselves with excess amount of food, excess amount of water. Make sure you have enough cash reserves to essentially cover the roof over your head. And then after that, after you got all of that settled, then I highly suggest you use my discounted free cash flow calculator, my book value calculator, as well as the recalculator. Find companies that you find companies that are undervalued based on their cash flow, based on their fundamentals, and if you like them and if your assumptions make sense and you find them undervalued, then by all means you should 100% invest in them because you want to grow wealth in the future. Eventually this will recover, and when it recovers, you will be very, very happy that you bought a significant amount of shares at a super low point after they rise several percentage points and we go back into a bull market. That pretty much does it for this video. Like if you like, comment, subscribe. It really does help here with the algorithm on YouTube. You guys can follow me on my YouTube site. All links in the description below, as well as the Let's Play channel. The link is also in the description. So with that said, peace out. Be on the lookout for the next video.